Hello, can you hear me?
Yes, good morning, Michael. How are you,
Hi,
sir?
not too bad. I'm trying my hardest because I'm such a newbie here. Try my hardest to share my screen. Just bear with me a second if you don't mind. Uh, Hold on a second. Has this worked? Yes, I think it has. Okay, right. Okay, we're cool, man. Okay. Hi guys. I'll just give it a couple of minutes before I get started. Um, I'll ask for your patience with me because I'm trying to kind of show my screen and I'm kind of trying to walk you through this as well at the same time. Um, I've had a bit of a think about this, and what I'm trying to provide here is I'm trying to provide you with a tool to be a bit critically minded, okay? So I have highlighted one example. I'm not picking on this company. I'm just, I'm highlighting one example, and you will hopefully just kind of use this as a kind of a foundation for other examples that you might have in your own portfolio and etc. And really, what we all kind of come from investing from different angles and stuff like that. So when I was kind of learning about investing, I was very much drawn to Joe Greenblatt, that a strategy that very much kind of made a lot of sense to me. And when he said this, it was just a passing comment, but it stayed with me. And I don't know if this will help you in your journey, but it kind of helped me. So he says, most businesses will just grow about plus or minus 5% per year. And I was like, wow, man, like the market is crazy. You can have like a good week, a bad week, and like it just everything changes in your portfolio. And I took that message and I kind of spent a bit of time reading about Michael Mauboussin. He has quite a lot of books, and I don't know if anyone has any of you ever read any books by Michael Mauboussin or heard the name Michael Mauboussin. So if he's a bit of a dry talker, but he kind of puts out a lot of numbers, and his books are very much about mean reversion and gives you just a lot of numbers. If you Google him afterwards, you'll see there's kind of, he works with Credit Suisse. He has kind of very short papers and has very lengthy books. He has, I'm sure I've not seen, but I'm sure he has like talks on YouTube. It's very much about looking towards base rates. So base rate means the likelihood that something is going to take place or not. So this kind of, I spend a lot of time thinking about Daniel Kahneman, Dudutsky. We've kind of spoken about this. Sorry, I'm butchering your name. I apologize. I'm really sorry. How do you pronounce it? Sorry.
Dudziński, Tomaszewski, but
Oh,
I'm trying to.
Yes, thank you.
Tomasz.
Yes, thank you.
Use Tomasz, that will be the best.
Thank you. So I very much like Daniel Kahneman because he's helped me a lot about dealing with my own emotional biases in investing. And the problem with investing, it's mostly a fight against you. Okay, so it's you are the biggest obstacle to your well-being in this. It's a business, really. Investing is a business. So what you're trying to do with these kind of base rates is you're trying to think, okay, the vast majority of businesses will not last 30 years. So you start from there, okay? So when you see a business that is priced beyond perfection, start from this line of thinking, okay? The vast majority of businesses do not last 30 years. If it's a technology business, their lifespan is even shorter, because if you have something like Coca-Cola, it's just selling you a product that can last a lot longer. If it's a hardware business, there's always someone coming in to cut away at your margin. There's that famous quote from Jeff Bezos, your margin is my opportunity. And his margin in AWS is now someone else's opportunity. So anytime that you have a business that has a lot of that is really priced very heavily, I just want you to kind of think back about this framework. A, most businesses do not last more than 30 years. B, just look for slight variations from quarter to quarter. If a business goes for many quarters growing at, let's say, plus or minus 5%, and then you see one quarter that the business is up 100%, just say, whoa, something interesting has happened here. This is not normal. Let's try and kind of dig through this. So again, I'm highlighting here BlackBerry simply because it's a company that I kind of spend a lot of time talking about it, and I look at it quite a lot. I have no opinion. If anyone listening kind of has BlackBerry shares, that's fine. But I'm just kind of highlighting this, and this is not picking on the company, okay? So the first thing that I kind of came across, so if you read the press release, they're not very upfront. So this is when it got released back, in June or something like that, June or July, I can't remember now. When it got released, the figures, they're not very much upfront talking about the fact that they had sold their intellectual property. In this case, it was some patents that they held. They were not very upfront about this. And they said, oh, our growth has just been exceptionally strong. What they did is they sold something off their balance sheet. Do you remember last week and the week before we talked about intangibles on the balance sheet? We're kind of talking about the fact that for the majority of the businesses, the intangibles don't really have a lot of value, particularly if they are, let's say, a tech business where they are just capitalizing the earnings on the assumption that those earnings that they've capitalized just means that you're kind of saying that what you've spent will be used up in time. So that's like not very complicated. Basically, if you're capitalizing a cost of something, you're saying that it's going to last you more than 1 year, for example. Otherwise, it would just be an expense. So if most businesses, when they're capitalizing, particularly if it's a tech business, it's an assumption, right? It's an assumption that business is going, that the value that you created will be used up over the next several years. So Tomas and I had interchange messages about Netflix. So Netflix is a business that I'll be kind of cross-referencing a lot today versus BlackBerry. So Netflix in 2000, I think it's around 2013 or something like that, they came out with quite a few series. House of Cards was one of them, okay? House of Cards 1 came out, and then House of Cards 2 came out. And they were extended the life of that library of House of Cards from 4 years to 10 years. So their assumption was, okay, in 10 years from now, House of Cards will still have some value. Now, I don't know about you people. I did watch House of Cards, and I can tell you that I probably wouldn't be that bothered to watch it now. Obviously we know about Kevin Spacey and all that, but even putting aside that question, that you might not resonate very well with you, but House of Cards is something that you may not resonate with today because you're kind of into something else. Maybe you want to watch something else. So the value that has been capitalized hasn't, in my opinion, been able to be sustained over those 10 years. But they've capitalized that, and they said, okay, we were able to have value accredited there, and we're going to use that value over a long period of time to continue to acquire customers, okay? So there's a question mark, okay, on the value of those intangibles. And going back to BlackBerry, so they have been saying for a long time that our intangibles have a lot of value. Our patents, we have more than 1,000 patents, our patents are worth a lot of money. Now, most businesses will not put any emphasis on that, so you can disregard those intangibles. But on the odd business where they do say, our intangibles have some value, I would take that on board. I would say, okay, it's not just nothingness, it's not just air that they hold something, okay? Now, then it becomes the question of how much do you value that something, okay? So BlackBerry been saying it's worth a lot. As it transpires, they sold those patents for approximately 275 or 260 million, something like ballpark, okay? So what they actually did in this instance, they added it to the revenues. Now, that's not really what BlackBerry does. BlackBerry nowadays, they sell cybersecurity products. Really, that's kind of, it has some other kind of telematics and other stuff, but it's not really selling patents. That's not their business. So you would say, if you were an editor or an auditor of this company, you would say, maybe, you shouldn't really be taking that onto your revenue stream, because that's just, a one-off cost. But it doesn't matter, putting that aside, they have added this here. So whenever you see that, that's the first thing I want to say. Just when you see a revenue growth kind of jump up quite significantly, I want you to just say, okay, how sustainable? That's just the question you put out, okay? And then you look down to the operating profit line. You don't need to spend too much time in most businesses spending, like going through the research and going through the SG&A and amortization. You don't need to spend too much time on that. Just look at the operating line, operating profits, or it would be something like that. This is kind of a clean metric of what the business is growing at, is what the business is delivering to the company, okay? So it doesn't take into account any kind of one-off charges or taxes or interest, okay? So it's kind of a clean metric that you can use to think about. So if the business in this case, George, can you see my screen here? Can you see my mouse or not really? Can you see it, my mouse? Okay, so
I can see.
okay, cool. So basically, if you look at the operating losses for the previous year, was a negative 177 million. So it's jumped to negative 11 million. So you see, well, that's a really strong jump. So if you see in your business is a very strong jump in profitability, just peel it back and just kind of think, okay, is that really something that I can count on going forward? It may be that it could be the case that they've basically closed down one part of their business line, which was burning a lot of cash, and they're going to be more profitable going forward. Just think about that, okay? The next thing I wanted to highlight, hopefully I can just scroll down here. Okay, so this gets a little bit complicated, but I'm going to kind of just spend a few minutes on this, and I'm not going to make it too complicated. When you look at a cash flow statement, so there are three statements that for any company is the income statement, the balance sheet, and the cash flow statement. Each one of them is very, very important. A lot of people don't spend a lot of time looking at the cash flow statement, but it has its equal weight. It's put there for a reason, and you don't need to kind of get like daunted by it or whatever. All you need to do is to look to see if there's any large number that sticks out. And if there is, just look at what that little entry is called. Now, I've highlighted here with the red arrow that you can see intellectual property disposed of by sale. And that shows as 147 million, which is more than they actually made in profitability in that quarter. You can see at the bottom in the square, it says 99 million. So they made in operating profits 99 million, but 147 million came from this sale of something. So you'd say to yourself, oh, has that happened in previous quarters? You just look through, and if it hasn't, can I really count on that going forward? So it's really that simple. You don't need to overcomplicate this, okay? That's really what you need to do. Just look at to see if there's any large number that sticks out. And I'll just add one final thing, that I give you this example of BlackBerry, okay? And I have no questions on it. But then I also said I'm going to revert back to talk about Netflix. So in the case of Netflix, the business, a lot of value investors have known for a very long time that its cash flow hasn't really matched up with its income statement. There's been this large discrepancy that I talk about. The business looks on an income statement, it looks quite profitable. On a free cash flow statement, it doesn't look that it's making any free cash flow. And if you were to take that on board, like many investors did, you would have missed out on Netflix doing really, really well. Now, I'm looking in hindsight, and I can tell you the story in hindsight why Netflix would have been an amazing investment. But with the facts that you had in your hand, you would have probably, like I did, you would have missed that out. Now, is that a problem if you miss out on an investment? That's not a problem. You know, the bookstore, the business stories and the financial books love to tell you, like, if you'd invested in XYZ 10 decades ago, you'd have been like, whatever. But the point is, you don't need to kind of do that in hindsight. All you have is the present time, and you have to take the facts as you have them. And if it doesn't suit your temperament, if it doesn't suit your personality, if you don't feel comfortable, don't chase it, because at one point or another, the share price will be down 30% or 40% or something like that in a very short period of time. And then you kind of be chasing it yourself and you'll be like, oh, like, what do I do now? You don't want to put yourself in that position. You either buy into the business and you're the owner of that business and you believe in the vision of that business is trying to do, or you don't. So if you don't, you kind of just don't get involved. And there's plenty of other businesses, maybe not this week, maybe like in a few weeks, maybe next month, you'll find something. If you're doing this, you'll find something that you can be assured of. Something will come your way that you will feel comfortable. So you don't need to kind of get yourself like too worked up. If you feel like, oh, I don't really feel very familiar with the cash flow statement, all you like trying to see is large discrepancies from one period to another. And yeah, that's my spiel. And I'm happy to take some questions now if you have any. Does no one have any questions? Okay, I'll just continue then. So the thing that I believe makes sense when it comes to investing, and this is what I try to do, is I'm trying to find a business that's relatively consistent. Where you get caught up and tripped up is where businesses are moving aggressively in one direction or another. And that's where it can get a bit dodgy. So I've tried to have a diversified portfolio with some businesses that are kind of more emerging, new kind of small cap businesses, and some businesses that are kind of more established, like Palo Alto Networks or something like that. Because what I'm trying to do, when the share price goes through over the course of a year, there's going to be periods of time where it seems on the surface that the value of that business is not being fully reflected in the share price, and you try your best to buy in at that point. Now, I'm not advocating for market timing, they're like, oh, the market is up or the market is down, you have to react. That's not what I'm talking about. I'm talking about there are periods, and I suggest strongly that you leave yourself plenty of weeks between making decisions in one new idea or something else. Leave yourself like 6 weeks or so that, because in 6 weeks in the market, a lot can happen. Things can go up, things can go down, a lot of craziness can happen. And you don't want to be in a position where you're buying into an idea and you feel like you're diversified but you're ultimately just buying into the same idea and you didn't see that until much late in the process. And by that, I mean, sometimes you kind of feel like, oh, I have this one business that is to do with, let's say, this fintech business, and this one other one that's to do with like payment solutions. And you kind of feel that they're diversified, but you're just making really the same bet. And sometimes you don't see that until some time has passed, like a few weeks or months. Then you can kind of, once you've been the owner of business, you kind of start to discern a little bit more of what you actually own and the bet that you made, whether like you were implicitly aware of it or not. So I am trying my hardest to find businesses that are stable, and we talked about this in the last 2 weeks. I'm trying my best to buy businesses where the balance sheet is clean, so that if things are not working out at that moment in time, like the Fed saying this or whatever, the market always catches on to something. There's always some bad news somewhere. I'm just trying to buy into businesses that the balance sheet is clean, so that's not like another concern of mine. The business can kind of tick along at a reasonable rate. They can turn around, and it often helps, and I try my best. It's not often the case that you can do that with commodity businesses. Commodity businesses, typically, they've been established a long time ago. But if you buy into something outside of a commodity business, typically the CEO or the management team as a whole may often own a substantial amount of stake in the company. And if they are highly incentivized with shares in the company, not necessarily that they're getting a large amount of salary, but if they're highly incentivized with a significant stake in the company, they will be highly motivated to make sure that the long-term shareholder is provided for, because ultimately management has one goal: to stay in business. You know, their goal is to stay as the management of that company. After that, everything falls into place. But for them to stay as management of that company, they need to make sure that the long-term shareholder is provided for. Because if you end up working, like, you know, trying to drive the share price too hard in a short period of time, and then things kind of fall apart and the share price falls, then an activist shareholder can come in and buy up 5% of your company and kind of try and oust the CEO. So the CEO needs to make sure that it's kind of managed with a view towards the long term. So the businesses that I'm trying to buy into are businesses that I'm hoping haven't got any kind of time bomb on their balance sheet, something that's kind of stable. And I'm trying my best to think about the underlying sector. So it's not necessarily always the case that buying into the cheapest business in that sector is the best way to go about it. Sometimes it is, sometimes it isn't. And for example, I kind of had my saving grace with the United States Steel was it was really so cheap compared to all the other guys that, like, when they kind of got bought out, I kind of was able to be made whole. It wasn't a great investment, but I kind of felt, okay, at least I was able to kind of survive, keep my capital and fight another day. Whereas sometimes you kind of want to go towards a business that may not be the cheapest. So, for example, this Palo Alto Networks, like, I don't think, like, objectively speaking, it's particularly cheap. I think it's quite a lot cheaper than its competitors, but I don't think that it's kind of like, you know, it's not like bargain basement cheap. But you have to kind of have a bit of try your best to have a bit of a critical thinking mind and think about what the business is, what's the scope of the business. You don't want to be caught into a position where you're extrapolating and you need to have quite a lot of growth going forward. That's kind of a bit more tricky, because what happens with the growth stocks is that sometimes you think that they can continue growing at, let's say, 40%, and then they kind of, for whatever reason, things kind of slow down slightly, and then you're like, whoa, you just get hit really hard. So, for example, a business that all of you will know is like PayPal. You kind of think the business is doing okay, and you extrapolate in that growth, and then all of a sudden the business is just under too much competition from all different sides, and that growth slows down, and then everyone starts asking difficult questions. It's like, oh, maybe the management getting paid too much stock-based compensation. Oh, I don't want to pay such a large multiple, and then all kind of problems and those problems tend to surface at the worst possible times. So, you know, you're never going to have all the answers, but you just try your best to kind of find a stable business, and most importantly, trying to have different ideas in the portfolio so that things can work out at different times. Because really, you just, all you're trying to do is to remain sane in this market. Yeah. Would anyone like to kind of ask anything? I'm just going to feel like I'm waffling here. No?
I think we all agree. That's why we are asking questions.
Okay, but ask, because otherwise I just feel like I'm just waffling, and I just kind of, yeah. Okay, I'll kind of, I'll talk about something else then, not about accounting. It's kind of
one question, so perhaps from me, because you started sort of giving a list of your investment criteria. So we know about the clean balance sheet, rather business. So is there anything else, if you were to name, for example, of Michael's checks that you do?
So is there anything else on my criteria? Was that the question? Was there anything else on my criteria?
I had problems internet connection. I didn't know if you could hear me. Yeah. So the criteria that you have, like clean balance sheet, rather stable business, or not going wobbly in all directions. Is there any other criterion?
Yeah. So Okay, so I'll start from the start, okay? The first thing that is really, really important is that you try your best to understand what the business is trying to do, okay? The more specialized the business, the more difficult it's going to be for you to kind of discern what the business is trying to do. But try your best to understand what the business is doing. That's the first thing I'd say. I personally feel that looking at the customer adoption curve is something that I find really important for me. You're never going to have a clear understanding of the business as much as the management team. They will talk and they will spin and they will say a lot of things, but you need some kind of indicator that you can rely on. I like to look at the customer adoption curve, and I put a lot more value on the customer adoption curve than I do on a revenue growth rate. Revenue growth rate is like BS, man. You can kind of have a good quarter, a bad quarter. That like means nothing. I'm looking for consistency, okay? If the customer adoption curve is relatively consistent, going up, let's say 2-3% each quarter, year over year, that's cool. But if it goes from, let's say, pretend growing at 10%, 10%, 10%, and then you get like 2 quarters back to back of 0%, I'm out. I had a vision for what I was getting involved with. My vision didn't align with the facts. I'm out. So I'm not going to try and kind of reverse engineer and say, oh, it was just because. If you have one bad quarter, I'm very understanding. Everybody has, it happens. You have 2 bad quarters back to back. That's it. It's game over. What you thought didn't align. And that's why I think it's so important. And I say to everyone, write down 3 bullet points why you're making this investment. And the bullet points should not include the valuation. It should not. You have 3 bullet points of why you think you're buying the business, and try and understand what the business is offering, and try to understand, this, like, what is a stable part of this business? So that's the first thing, okay? The customer adoption curve, the stability of the business. The second thing that I personally find really, really important is I want to see in the next like 12 months to 18 months, I want to see that the business is going to be break even on a cash flow basis. So you can put into question, stock-based compensation, this, that, the other. That's fine. All of that. I just want to make sure that the business in 12 months or less is going to be stable. I want to try and get as quickly as possible to that, because, when the business is stable, a lot of things can kind of fall into place, and you can kind of optimize for this, optimize for that. That's all fine. But the business, just want to get to that point, make sure that the balance sheet is working. So if I was to kind of enumerate, number 1 would be the balance sheet. That's the most important. Number 2 be the customer adoption curve. I would say that's really, really important. Number 3, I would say the business is going to kind of reach profitability like 12 months, maybe as soon as possible. I just want to know that if things go crazy, I'm going to be okay. Because you, like I said at the start, like, you don't want to be in a position where you're full of doubt at the wrong time. So if you follow these kind of criteria quite strictly, and you say, this is the 3 things that I'm looking for, and you see, like the example that I talked about before a few weeks ago about Farfetch, the business is kind of like, is it going to be okay? Is it not going to be okay? And then like they take on load the debt onto the balance sheet. If you have very strict criteria, like 1, 2, 3, and it kind of goes off that, you know that you're out. There's no question marks. You're not kind of like, oh, I feel bad, but like you're out. There's no, then you don't need to be worried about it didn't comply. It wasn't for you. No problems. You don't get emotional about it. So I think that for me, I'm in a privileged position that I kind of write a lot. So I end up writing a lot of my, what I share with you guys, and I read my own stuff, and I kind of go through and I read what I was thinking, like what, because, Charles Darwin, like, he's always looking for disconfirmation evidence, right? So your mind has this inclination to try and trick you, okay? That's like the mind wants to trick you, okay? And when you look for something that doesn't align with what you previously thought, it's working really hard to push that aside. It doesn't want to carry that extra idea that kind of disconfirms with your original hypothesis. It's like, oh, it was just an abnormation. Don't worry about it, right? And that's why I kind of like, and I say to you guys, like, write 3 bullet points and keep it like on an Excel spreadsheet or whatever, so that you can kind of go back to it and say, okay, this is what I thought, 1, 2, 3, and it's changed, and then you kind of like, okay, I'm out. But so it's like it's quite mechanical, and that's what I think. The more mechanical you are about investing, the less emotional you are. I think that's kind of really helpful, and I hope that that kind of helps kind of formulate how I think about investing. Still got a few minutes. I mean, if you guys have any other calls, any questions, like, you know, jump out, let me know, because yeah, I'd like to try and provide some help if I could. Go ahead, George, please. Thank you.
You put out a lot of articles on Seeking Alpha. Do you have a team that helps you? Because, I mean, you obviously do look at a lot of stuff, but you post so much. I was just wondering if you have assistants to do some of this work for you.
No, not really. No, no. I get up really early. I grind like a dog. I mean, there are no shortcuts, right? Like, there's no free lunch, you know. But I will also say that for me personally, because I do this so often, I try my best, like once every 2 weeks or something, to look for a new company. Because you know, if you rest, you rust, right? So if you kind of just fall into your kind of, you fall in, it's like working out at the gym. If you always go and do the same routine, your body kind of adjusts that, you're not really growing. So for me, I find it really important to, and it's difficult for my mind, you know, because I kind of like, oh, I have to learn about this other business, and it kind of like, I kind of find it quite daunting, if I'm honest, and I find it kind of overwhelming. And the way I see it myself is like, okay, this is the first go at this new business that I've not really done. I'm just trying to like push it over the line. I'm just really trying to get the boulder over the line. And the next time I will read through the comments that people gave me, and I'll read through what I thought, and I'll read about the company's next quarter, and I'll try and say, okay, this is what I thought, this is where I was wrong, this is where I can improve. But I'm really just trying to kind of get that boulder up across. It's like, I always think about like working out at the gym. You're just kind of trying to push it forward a little bit, and you know, nobody's perfect, right? We all kind of make mistakes, and you just try your best. And what I've tried, but you know, this is my full-time job, as you know, but what I've tried to do is really just let my mind expand and not be afraid to learn new ideas. And it's quite difficult. We're creatures of habits, right? It's really difficult to learn new tricks. And you, George, and other people on the call are in a privileged position, because you don't need to kind of formulate your view on a new company. You kind of have a read, it's like, oh, that sounds interesting. The counter problem of that is that if you're not putting out your idea, you only really learn something when you're able to kind of say it to someone else, okay? So when you say it to someone else, you kind of see, oh, actually, I don't know about this. I never really thought that Amazon has like a cloud business or something. It's only really when you're forcing yourself to be in that position. So on the one side, it's privileged position not to kind of have to put out your thoughts. The other side is that it's kind of, because you're not putting out your thoughts, you're not testing yourself, and you're not putting yourself on the grill. And we really typically, you know, we're designed for like a fight or flight, and we really kind of survive better in those kind of high adrenaline kind of situations. It's kind of a long-winded answer to your question, but I just hope it was helpful.
Thank you, Michael.
Okay. If we don't have any more questions, I'll just, oh, you have a question, Axel?
No, thanks. I'm fine.
Thank you so much, everyone. I really appreciate you guys coming. And yeah, please, yeah, go ahead.
Do you have time for one quick question?
Yeah, go ahead.
For selling a stock, for example, UEC, it keeps going up and up, and up little, and it's doing well. Do you have a sell point in mind right at when you start the stock, or how do you know when it's hit its climax?
So I recommended USC at $7 a share. I'm well underwater. I think it's like $4. So like I got killed there. Just being upfront, transparent. You know, I've written about this many times. There are a few businesses, very few, like this uranium one, Antero, that I really don't want to sell because I want to see that I really buy so much into this vision that the energy transition is going to take place. And I recognize that 2022 and 2023 hasn't happened, but I very much believe. So those are the two businesses, maybe within that tech resources, maybe these three businesses that I really don't want to sell. I just want to hold on to them. Most businesses, I am looking for about approximately 50% return or 2 years, whatever comes first. Now, I have a few positions like Builders First Source that has done quite well for me. I might sell that soon. I've had it for a bit of time, but the reason why I don't want to be too aggressive in kind of buying and selling is what we discussed a few moments on the call. You don't want to kind of be, oh, the market is up and everything. Like, I don't want to have to react to the market, okay? I want to kind of layer out so that over time, I'm pruning here, I'm adjusting and buying here. I don't want to kind of go and like, oh, the market is up and let's get excited, let's buy stuff. You know, I want to kind of just lengthen out the process. And I think that's really, really helpful because you are removing this impulse from yourself. I said at the start, your biggest restriction is you against you. So you need to put in place, you need to know yourself, what is your biggest faults. And my biggest fault is that I'm very kind of passionate. I want to react and do something. So I'm putting grids, I'm putting a frame against myself, stop myself from reacting. So it kind of is a long answer, but when it comes to like a few companies like UEC, Uranium Energy Corp, Antero Resources, Tech Resources, I'm kind of just trying to kind of be a bit kind of calmer. But other businesses, I kind of 12 to 18 months, it's either worked or it hasn't, and I'll kind of try and sell if I can and move on.
Thank you, Michael.
Okay, guys, thank you so much for coming. I really appreciate it. I hope you'll see you next week. And yeah, have a good week, okay?
Thank you for your time.
Thank you so much. Thank you.